Despite the renewed sense of optimism in the economy and in the banking industry as we head into 2024, concerns about commercial real estate remain front and center for regulators, investors, analysts, you name it. Now, for bankers, dealing with concerns about commercial real estate is nothing new. It feels like every 2 to 3 years, the regulators in particular talk about how they are once again concerned about commercial real estate and how in upcoming exams, they're going to expect X, Y, and Z from banks who have CRE concentrations. But this time, the pressure and the spotlight on these issues feels different, and banks are going to need to respond differently to these concerns than they have in these previous waves. Let's first examine why this time feels so different. First of all, the concerns about commercial real estate this time have gone mainstream. It's not just the regulators anymore. The media is covering it. Investors in commercial real estate investment trusts have punished their stock prices. And of course, the regulators are deeply concerned. The FDIC just a couple weeks ago updated an advisory notice, which is an unusual step for them. They updated an advisory notice that goes back to 2008, basically laying out why they're so concerned about commercial real estate and what they expect from banks in their next exams. As I mentioned before, it always feels like the regulators are concerned about commercial real estate. But let's call a spade a spade. They are licking their wounds right now because of what happened with Silicon Valley Bank and First Republic Bank and banks like it in the spring of 2023. Bank failures are not just bad for bankers and investors and banks. They're bad for the regulators because there was an examiner in charge and an office who was responsible for that bank failure and let it happen. And no examiner wants to have a failed bank laid at their doorstep. As a result, their posture towards these concerns right now is going to be far more aggressive than what banks have experienced in previous cycles, going all the way back to 2008 global financial crisis. We're already seeing it in the exams of many of our bank clients. Now, how did we get here? Where are these concerns coming from? It goes back to the pandemic and the fact that there have been structural changes in the economy because of the pandemic, most notably work from home policies and the impact it's having on the office sector. And a lot of the articles that the media puts out, the headline is concerns about commercial real estate. But when you read the article, it's really focused on the office sector. At least it was, I'd say, the articles that first came out in the first half of 2023. But the concerns about commercial real estate have expanded from the office sector into other sectors. It feels like the next sector that has a bullseye on it right now is multifamily because of concerns about slowing rent growth and the supply of apartments that have come online in 2023, roughly 500,000 or so units. But it's also expanding beyond that in terms of the concerns that stakeholders have about commercial real estate. What about all the loans made in the zero interest rate period of 2021 and the first half of 2022? A lot of commercial real estate loans were made in that period at very low interest rates. A lot of those loans are going to reprice or need to be refinanced in the next couple of years. And all of a sudden you have a bunch of loans that were priced at 4%, needing to reprice at 8 or 9%. So there's a lot of concerns about that as well. Now, here's what community banks need to immediately understand and recognize. In the eyes of these stakeholders, you are guilty until proven innocent, whether it's fair or it's not. And frankly, for a lot of you, it's not fair because banks all have different exposures to commercial real estate. Many community banks don't have any office loans in their CRE portfolio. And a lot of community banks that do have office loans have them located in suburban markets where the vacancy rates aren't that bad. A lot of the articles that come out about concerns about the office sector are focused on offices in downtown San Francisco and New York City and the like, where the vacancy rates have plummeted. But in a lot of markets across the United States, people are going back to the office, or they're going back to the office enough where the vacancy rates aren't that bad. Multifamily, same thing. Most of the concerns about multifamily are focused on the higher end apartments. The apartments that are going to price at market rates. But the risk profile of workforce housing or affordable housing is very different than those luxury apartments. So even within a single property type, you have to look deeper to really understand the unique risks. And banks have different exposures to multifamily in that regard. Structuring matters. A lot of banks structured their loans with longer dated maturities. Now, the good news is that the borrower doesn't need to refinance at a lower rate. The bad news is that the bank took interest rate risk, but that's a different problem. Banks also took different approaches in terms of whether or not they used teaser rates or interest-only periods or what the amortization schedules would look like. All of that matters and factors in to the overall risk that a given bank has. And banks have done that very differently. Vintage matters. I talked about the concerns that regulators and other stakeholders have about loans originated in 2021 and the first half of 2022 at ultra low interest rates. Well, some banks were less aggressive growing during that period and therefore have less exposure to those type of loans. Other banks grew far more aggressively and have a lot more exposure. So when you grew, the timing of growth is another differentiating factor that will separate lower risk profile banks from higher risk profile banks, and that should be taken into account. Each bank also has a different capacity to absorb these risks. Some banks have more capital in terms of quantity or higher quality forms of capital. For example, the holding company is a source of strength and can downstream capital to the bank charter. Some banks, the holding company is a source of weakness because it needs a dividend from the bank charter every quarter to service debt. That matters. Earnings, of course, matters because earnings is the primary source of capital because that's how capital is internally generated. So quantity and quality of earnings matters too. That will separate lower risk profile banks from higher risk profile banks. The liquidity profile also matters. Banks with strong deposit franchises and are not overly dependent on broker deposits or federal home loan money will have far more flexibility with restructuring problem commercial real estate credits if those problems emerge. So what to do about it? Well, again, like it or not, you are guilty until proven innocent. And the only way to deal with that is you have to take control of the narrative. You have to tell your story, but you can't just tell your story with words. You have to tell it through data and analytics. And the best way to do that is through stress testing, because stress testing is the ultimate measurement of credit risk. Your run-of-the-mill check-the-box stress test isn't going to cut it anymore. Your stress test has to have certain capabilities or otherwise it will not help you in this regard. What are those capabilities? Number one, you've got to be able to run at the loan level. A top-down superficial stress test is a waste of time. I don't care what your investment banker tells you. Number two, you have to be able to differentiate by property type and by vintage and by structure. If you treat a 2018 strip mall loan where the borrower is not overly dependent on an anchor tenant for rent, the same as a shopping mall loan you made in 2021, your model is broken. I don't care what the debt service coverage ratio or the loan to value are on those two loans. That 2018 strip mall loan has a much lower risk profile because of when it was made and the type of property it is and the lack of dependency on an anchor tenant. Your stress test has to quantify the impact on capital and your loan loss allowance. Otherwise, it's very difficult to derive value and action items from this process. And that really means the best stress tests are the ones that use CECL compliant methodologies, because that's how you can measure how you would actually have to build your allowance should stress materialize. You also have to be able to run your stress test through a complete P&L and balance sheet so you can quantify the impact on your regulatory capital ratios. Your stress test has to be able to handle multiple scenarios. Also, you should be doing sensitivity testing. And by the way, sensitivity testing is not the same as stress testing. What is sensitivity testing? Sensitivity testing is when you shock the borrower's and net operating income levels and recalculate the impact on the debt service coverage ratio. Or perhaps you shock the interest rate and recalculate the impact on the debt service coverage ratio. Or maybe you shock the cap rate or the property value and you quantify the impact on the loan to value. That's a healthy exercise, but that's not stress testing. That's sensitivity testing. You should be doing that, but it's not a stress test. Finally, you need to be able to synthesize your results. right? I'm telling you, you need to do a variety of analysis here, but you need to be able to synthesize it into 3 or 4 or 5 at the most key findings and recommended actions. And what kind of recommended actions could there be? It could be, hey, we need to tighten our capital limits. We need to hold more capital. It could mean we need to adjust our underwriting philosophy and be a little bit more conservative. There's a variety of different actions. Another one could be we may need to tighten our commercial real estate concentration limits relative to capital. It could be the reverse too. Hey, we're fine. We can keep lending. And in fact, we should be looking to take advantage of this environment. Speaking of, one more thing. What if a crisis does happen? If you've gone through this process, you'll be prepared. And that's great. You'll be prepared because if you've done this properly, you will set aside enough capital to absorb the risk, which also means you know how much excess capital you have. And that excess capital is really important because that excess capital is your war chest. And if we do have any kind of downturn or crisis, mark my words, the best time to make loans is in the worst of times. The best loans are made in the worst of times. That's when you take market share, when everybody else stops lending, but you have the war chest and the conviction to make loans. The best loans I've ever seen in my career were loans that banks made in the second half of 2009 and 2010 and 2011. In fact, some of the worst parts of the global financial crisis, when unemployment was at 10%, when property values had already collapsed by 40%. That was also reflected in the underwriting, which actually reduced the risk of loans that were made at that point in time. And you actually got good interest rates on them. So remember that. Best loans are made in the worst of times. This is not just about defense, it's about offense too. I hope you enjoyed this video. Please subscribe to our channel for more videos like it. Talk soon.